What if the biggest mistake XRP investors are making right now isn't failing to buy more XRP, but failing to understand what they already own? Because according to Jake Claver, one of the most talked about voices in the digital asset space, the overwhelming majority of XRP holders are dramatically underestimating the assets sitting in their wallets. And that's not because they aren't paying attention, it's because they're looking at XRP through the wrong lens entirely. Now, normally when someone starts talking about massive price targets, it's easy to tune out. The crypto industry has no shortage of bold predictions. But what makes this situation different is that Claver isn't just talking about a higher price. He's talking about a completely different way of valuing XRP. And when you combine that with his latest prediction of an $8 to $25 XRP move, along with his warning that the rally could be violent, the conversation suddenly becomes a lot harder to ignore. Welcome back to XRP Matrix, the channel where we break down the biggest XRP developments, the most important market signals, and the stories that could shape the future of digital finance. Today, we're taking a close look at Jake Claver's latest XRP outlook, why he believes the next major move could happen much faster than most people expect, and why he thinks many investors still haven't grasped the true significance of what XRP could become. Whether you're bullish, bearish, or somewhere in between, this is one of those discussions that's worth understanding because it touches on something much bigger than a simple price prediction. It touches on how markets value infrastructure, how institutions allocate capital, and how entire financial systems evolve over time. So stay with me because there's a lot to unpack here. The first thing that stands out about Claver's thesis is that he doesn't begin with charts, technical indicators, or market sentiment. Instead, he starts with a simple but powerful claim. He believes most people are valuing XRP incorrectly. In his view, investors continue treating XRP as a speculative cryptocurrency when they should be evaluating it as financial infrastructure. That distinction changes everything. Most traders look at an asset and ask one question: how high can the price go? Claver looks at XRP and asks something completely different. He asks how much value could eventually move through the network if adoption reaches the levels supporters expect. That's a fundamentally different approach. Infrastructure isn't typically valued based on today's activity. It's valued based on future utility, and according to Claver, that utility is the piece of the puzzle many investors continue to overlook. Now, it's worth taking a moment to understand who Jake Claver actually is because the source of any prediction matters. Claver isn't a random social media account throwing out moonshot targets for attention. He serves as chairman of Digital Ascension Group, a multifamily office focused on helping wealthy families and institutions navigate digital assets. That means his perspective is shaped by years of observing how large investors evaluate opportunities, assess risk, and position themselves for long-term trends. Supporters of his analysis argue that this gives him insight into institutional behavior that many retail investors simply don't see. Whether every prediction turns out to be correct is another question entirely, but there's no doubt that his views attract attention because they come from someone actively involved in conversations surrounding digital asset adoption and institutional investment. One of Claver's most striking descriptions of XRP is his claim that it could become the most pristine collateral the world has ever seen. That's a bold statement, and it's worth thinking about what he actually means by it. He's not describing XRP as just another cryptocurrency competing for market share. He's describing it as a potential foundational asset that institutions could use within broader financial systems. Collateral plays a critical role in global finance. It supports transactions, reduces risk, and enables massive amounts of economic activity to take place. When Claver talks about XRP in those terms, he's painting a picture that extends far beyond speculative trading. He's suggesting that XRP's future value may ultimately be tied to the role it plays within financial infrastructure, rather than simply the enthusiasm of retail investors during a bull market. Of course, infrastructure narratives are interesting, but they don't automatically create price appreciation. That's where Claver's short-term outlook enters the conversation. He has discussed a potential XRP range of roughly $8 to $25, and what makes that prediction particularly interesting isn't just the number itself, it's how he expects the move to happen. According to Claver, if XRP begins its next major advance, it may not unfold through a slow, gradual climb. Instead, he believes the market could experience a rapid repricing event driven by liquidity conditions. In simple terms, he argues that there may not be enough sellers available at higher price levels to absorb a sudden surge in demand. If that demand arrives quickly, prices could move dramatically in a very short period of time. That's why he describes the potential rally as violent rather than steady. To understand this argument, imagine a situation where a large number of buyers suddenly enter the market at the same time. If there are plenty of willing sellers, prices rise gradually because supply and demand remain relatively balanced. But if sell orders become thin and buyers start competing for a limited amount of available XRP, the market can move much faster than expected. Prices don't necessarily climb one step at a time. Sometimes they jump, sometimes they gap higher, sometimes they move so quickly that people watching from the sidelines don't have time to react. Claver believes XRP may be positioned for that type of environment if institutional demand accelerates while available liquidity remains constrained. Whether that scenario unfolds remains uncertain, but it's a key part of why he believes a major move could happen much faster than most investors anticipate. What's interesting is that Claver often points to previous market anomalies as examples of what can happen when liquidity conditions become unusual. Over the years, XRP has occasionally experienced sudden price spikes on certain exchanges that seem disconnected from broader market activity. Critics dismiss these events as glitches or isolated incidents. Claver views them differently. He sees them as demonstrations of how quickly prices can move when supply becomes scarce and demand increases unexpectedly. Now, it's important not to overstate the significance of those events because isolated spikes don't necessarily predict future outcomes. However, they do illustrate an important point. Markets are not always as orderly as people expect. Under the right conditions, prices can move far more aggressively than traditional models might suggest. The obvious question then becomes this: what could actually trigger the demand surge Claver is talking about? According to his thesis, the answer isn't a single announcement or headline. Instead, it's a collection of developments that may be converging at the same time. One of the biggest factors involves growing institutional access to XRP. Large financial institutions generally prefer regulated investment vehicles and clear compliance frameworks before committing significant capital. As access improves and regulatory concerns become less significant, Claver believes new demand channels could emerge. That's important because institutional money operates on a scale that retail investors often underestimate. Even a relatively small allocation from large investment firms can represent billions of dollars entering a market over time. Another pillar supporting Claver's outlook is Ripple's continued effort to expand its presence within the broader financial ecosystem. Supporters frequently point to Ripple's investments in infrastructure, custody solutions, payment technology, and institutional services as evidence that the company is building for long-term adoption rather than short-term hype. Claver often highlights these developments because he believes they strengthen the overall utility case for XRP. In his view, every piece of infrastructure being built today increases the likelihood that digital assets become more deeply integrated into traditional finance tomorrow. Whether every initiative succeeds is impossible to know, but the broader trend remains difficult to ignore. Ripple continues positioning itself as a company focused on practical financial applications rather than speculative narratives alone. Regulatory clarity also plays a major role in Claver's thinking. For years, uncertainty surrounding cryptocurrency regulation has acted as a barrier preventing broader institutional participation. Many organizations simply aren't willing to take significant exposure to assets operating within unclear legal frameworks. Claver argues that as those uncertainties continue to diminish, institutions that have been waiting on the sidelines may finally begin participating more actively. This is one of the reasons he believes the market may be underestimating future demand. From his perspective, the technology itself isn't necessarily the problem. The hesitation has often been regulatory. Once that obstacle begins disappearing, the conversation changes dramatically. Instead of asking whether participation is possible, institutions begin asking how much participation makes sense. This leads directly into what Claver refers to as a domino effect. Rather than expecting one event to transform XRP overnight, he envisions a chain reaction. Regulatory clarity encourages institutional involvement. Institutional involvement increases liquidity and utility. Greater utility attracts additional adoption. Increased adoption drives further confidence. Each development creates momentum for the next. That's the framework he uses to explain how XRP could transition from a largely speculative asset into something much more significant over time. Whether investors fully agree with that sequence is less important than understanding the logic behind it. Claver's thesis isn't built on a single catalyst. It's built on the interaction of multiple catalysts reinforcing one another over a long period. Of course, no discussion of Jake Claver's predictions would be complete without acknowledging where previous forecasts have fallen short. He has made ambitious projections in the past that did not materialize within the expected timeframe. Critics are quick to point this out, and it's a fair observation. Timing matters. Investors care not only about direction, but also about when a thesis might play out. Claver's response has generally been that infrastructure development takes longer than markets expect. Building relationships, navigating regulations, and integrating new technologies into existing financial systems is rarely a fast process. While some people view missed timelines as evidence that the thesis is flawed, Claver argues that delays do not necessarily invalidate the broader direction of the trend. Whether investors accept that explanation is ultimately up to them. One of the most important lessons from this entire discussion is the difference between being wrong on timing and being wrong on direction. Markets often treat those two things as if they're identical, but they aren't. History is filled with examples of transformative technologies that took longer to gain traction than early supporters expected. During those periods, believers were frequently mocked, criticized, and dismissed. Sometimes they were ultimately proven wrong. Other times they were simply early. Claver's supporters argue that XRP may be experiencing a similar dynamic today. They believe the market remains focused on short-term frustrations while overlooking longer-term structural developments. Skeptics disagree and argue that future adoption is far from guaranteed. Both perspectives deserve consideration. As we bring this all together, the reason Jake Claver's comments continue generating attention becomes much easier to understand. His outlook isn't based on a single rumor, a single partnership, or a single market event. It's based on a broader vision involving institutional adoption, regulatory progress, financial infrastructure, utility-driven demand, and the possibility that XRP eventually plays a much larger role within global finance than many people currently imagine. His $8 to $25 target is certainly ambitious, and there are no guarantees that XRP reaches those levels. But the deeper question he raises remains fascinating. What if the market is still valuing XRP as a speculative asset while the foundation for something much larger is quietly being built underneath the surface? That's the question investors will continue debating in the months and years ahead. And if Claver is even partially correct, the next chapter of XRP's story could look very different from everything we've seen so far. Until next time, stay informed, stay patient, and keep your eyes on the bigger picture. This is XRP Matrix, and we'll see you in the next one.